I'm joined from Zurich by Dan Scott. He's research analyst at Credit Suisse. Welcome to the program, Dan. What do you make of the reaction we're seeing on the markets?
Good morning, Lindsay. Well, I mean, we've been tactically neutral on equities for a while because we've been concerned about these risks that have been on the agenda and in part foreseeable. There's one extra piece to the puzzle that hasn't been mentioned so far this morning, and that is a possible recapitalization of Spanish banks. So if you need another thing to worry about, that's also something that we have on the agenda, and another thing that could be a hiccup and a reason for investors to go risk off. But certainly what we've had over the weekend with election results from France and also the polling results from Greece will be something that has investors sidelined.
When you say that you're neutral on European equities, where are you invested? How much exposure do you actually have?
Well, at the moment, this is a position on equities overall that we have neutral, and that's a tactical one. Strategically, actually, on a longer-term basis, we're still constructive on equities. But for all asset classes, I think this morning, especially European ones, I think you'll see an added risk premium being added right now. I mean, if you try and drill down into the individual stories that we have this morning, say the French elections, for example, I think there you can see some differentiation. There has been a lot already priced in to French equities, for example, in results to what an Hollande win could bring for French equities. The CAC 40, for example, has been trading at a discount to European markets since October last year already, when Hollande had a very strong lead in the initial polls for the election. So there's already been a discounting of French equities for quite some time ahead of this election result. So the knee-jerk reaction this morning shouldn't be anything all too big. In fact, I think what you can start to see maybe is going into the parliamentary elections that we have in June, some clarification coming through exactly on what his policies will be, because there still are some question marks on exactly what his plans are, not only for the banking sector, but also for insurance and on gas and water prices. So there are a number of sectors where there's still some risk and some insecurity being priced in.
And he's going to have to be forthcoming and clarify all of these policies. Indeed, he has been pretty thin on detail, Hollande, hasn't he, over the course of the campaign. I wonder, though, what's happening, what the French bond market is telling us, because you have this narrowing of spreads between France and Germany since the first round of the French elections. I wonder if investors are thinking that really, in the end, Hollande's not going to be able to do very much because his hands are tied to an extent, aren't they?
His hands are tied, although the election results in France and Greece certainly don't add any confidence in terms of what's going to be happening with Project Euro. I mean, our base case is still that Greece remains in the Eurozone, but I think you'll see some insecurity now creeping back into markets after the poll results that we had in Greece. There definitely is a focus back on those parties that are calling for growth. And so I think when France and Germany go back to the negotiating table, there probably will be some sort of a deal struck between growth and austerity in ratifying the fiscal compact. Maybe there'll be a growth compact or a fiscal growth scenario as well that Hollande manages to bring to the table for his supporters. So yeah, there are likely going to be increasing risk premia priced into the market. Okay,
now you mentioned earlier that some of those sectors that are going to be the most affected by Hollande's policies, gas, electricity, insurance, negatively affected. But what about those stocks that won't be negatively affected, that are perhaps discounted a bit unfairly at the moment?
That's right. One of the scenarios that we've built, especially on French equities, was to take a look at what discounting had happened and where there might be some opportunity, i.e. where there might have been too much of a discount applied to individual equities. And what we came up with was a number of companies that actually have very little exposure to France itself, and also have zero exposure to the policy implementations as expected from François Hollande. So what we came up with were companies like Pernod Ricard, which have around 10% of their sales in France, just over 10% of their sales in France. But as their latest earnings show, most of their growth is coming from emerging markets. And in fact, what you're actually seeing is a continuing trend to higher cost products. So they're more expensive of their drinks range. And that's definitely been something that's been a positive. And given this low exposure both to policy and to France's economy, Pernod Ricard is a company that we like from that perspective. LVMH is another one. That's a company that has about 10% of sales also from France. And that 10%, should be noted, includes all the tourist sales that you have from Japanese tourists, for example, going to Paris and buying their handbags there. So definitely also a company that has very little exposure.
So those companies that are the least exposed to France. Thanks very much, Dan Scott, research analyst at Credit Suisse.